Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. All right, good afternoon, everyone. Thank you for joining my Tuesday session on real estate and taxes. Today, we're going to be talking about how can you save taxes when you're flipping houses. Let's assume you have a house that you just purchased and you wanted to make a profit on it. Sometimes you buy a fixture upper, you put some renovations on it, and then you resell it for a profit. That process is technically called flipping. So a lot of the people in the construction industry and even real estate industry are basically making income out of this, and it's a very lucrative option. So the idea is don't really move into the house. You basically buy it, you renovate it, and you resell it within a year. It could be 6 months, it could be 8 months, it could be even 4 months. So when you're doing this repetitively, you're technically earning money, you're earning business income, or you can also call them capital gains tax. In the past, you had the option of determining if it's capital gains tax versus business income tax, but now all of the income is subject to taxes. That means we're gonna rule out the capital gains tax theory. Every single time you flip a house, it's considered a business, and when you are in the business, you are paying business taxes on 100% of the gain. So in this scenario, let's assume I bought a house for $500,000, I sold it for $600,000. The $100,000 profit will get added to my personal income for that year, and I will be paying taxes on the entire $100,000, as opposed to only paying taxes on 50% of the gain, which is capital gains tax. Most recently, a lot of people were in the business and trying to speculate on the price of the house just like stocks. So they'll buy it at a low price, and then within a few months they'll quickly flip it for a profit. Sometimes they didn't even do any improvements. They just got a good deal and they flipped it for profit. When you're doing this kind of speculation, the government doesn't like it because it's pushing the price of the houses up, and it's making unaffordable for Canadians to buy their first home. So what have CRA done? Most recently, CRA has come up with a new rule called anti-flipping rule. This started in January 2023. Just like the name suggests, CRA is trying to curb the practice of speculation where you buy it and within 365 days, you basically resell the house for a profit. It's basically telling people that if you're gonna buy a house and flip it for a profit within 365 days, you're gonna be paying taxes on it. Potentially, what used to happen is, if let's assume I bought the house and I moved into the house, that would become my principal residence. So when I'm flipping the house for a profit, I did not need to pay any taxes. So a lot of the people would used to do that. A lot of the people in construction industry would technically buy a fixture upper and then move into the house, show it as their primary residence, and then once they have done all the renovations, they'll flip it for a very high price for a profit and not pay any taxes. Why? Because on all of the principal residence, capital gains is exempt. There's no taxes on principal residence. So what CRA has done is now they have put a rule in place called anti-flipping rule, which will basically stop you from doing that, because you need to be in that house for at least 365 days before doing so. So if let's assume I decide to flip a property today and I don't want to pay taxes, I can technically buy the house while it's being renovated. I can start living out of the house and then flip it for a profit. CRA has imposed a rule. Now I won't be able to do that. Why? Because what I was thinking was I would just basically in 3 months flip it for a profit. They are saying you need to stay in the house for a minimum of 1 year before you can flip it. Otherwise, we will charge you taxes. So I hope this makes it clear that anti-flipping rule is basically just for, it doesn't make any impact for people who are already in the flipping business because they're going to be paying taxes regardless. It only impacts people who were doing it by making it their principal residence and not paying any taxes. They would technically just show that, I'm living out of the house and I don't have to pay taxes because it's my primary residence. But now with the anti-flipping rule, this has changed. You would need to stay in the house for at least 365 days before you flip it for a profit. This basically applies for all the pre-construction sales, purchases that you have done, any assignment sales that you're doing, even the ones that are not ready yet, even assignment sales in pre-construction, even then, you'll be subject to this anti-flipping, as well as fixture upper sales. All three categories are basically captured in this. So make sure if you are thinking that, I would simply move into the house and not pay any taxes, that has changed with this new rule. All right, so what are the tax implications on house flipping? A lot of the people already know whenever you buy a house and you sell it under your personal name, if it's an investment property, the profit from that sale would technically be added to your personal income. When it gets added to your personal income, you pay taxes based on whichever bracket you're in. If you're earning $100,000 and you added another $100,000 from profit of the sale of property, your total income becomes $200,000 for a year. And as you make more money in Canada, the taxation system is progressive. So if you're making $40,000, it's 20%. You make $100,000, it becomes 30%. And then it keeps on moving up and up as you make more money, with it being as high as 55% taxes if you buy it under your personal name. What happens if you want to save on these taxes? Because we already know that, under your personal name, you pay, as you add more income to your personal name by flipping, you're paying more taxes. So is there a way to lower that tax liability? There is a way. The way is you incorporate a business and then do the flipping under your corporation. So let me show you an example of how you can save taxes on flipping on houses. I'm going to talk about two cases where we're going to first talk about when you were flipping under your personal name, and the second option would be when you're flipping under your corporation's name. So in this scenario, case number one, when you're flipping a house under your personal name, let's assume you bought the house in 2022 for $500,000 and you input $50,000 in making it, renovating it, and so on. So your total cost of the house became $550,000. 6 months later, you decide to sell the house for $650,000, pocketing $100,000 net profit. Now you must be wondering, how does the taxes work on this $100,000? My assumption is if you're making $100,000 personal income and $100,000 profit, your total income will become $200,000. So how would you get taxed? On your personal income, your tax liability is 22%. Once you add the profit from your real estate by flipping the house, your total income has become $200,000. Now your tax liability has gone up from $22,000 to $68,000. The additional $100,000 that you made technically caused you to pay almost $45,000 of additional taxes, which is a lot of money. So nobody would want to pay this, right? How can you basically reduce your tax liability? Let's look at case number two. In case number two, you are flipping inside the corporation and not doing it under your personal name. Let's assume you close the house for $500,000 under your corporation, same level of expenses of $50,000, it cost you $550 as a total. 6 months later, you see the market was going up, you decided to sell the house for $650. Once you sell the house for $650, your net profit is exact same, which is $100,000. On $100,000 profit in the corporation, there's only 12.2% taxes. And on your personal income, you were supposed to pay $22,000 tax anyways. This is your salary income. This has nothing to do with the real estate profit. I just assumed that your current year income was also $100,000. Although you are making $200,000 in total on paper, you are saving $33,000 when you are doing this process under corporation. Why? Because on $100,000 profit under corporation, you're only paying 12.2% taxes. On the personal income, you're paying $22,000 taxes. If I basically add both of these and subtract it from the previous example of $68,000 tax payable, you are technically saving $33,000 of taxes when you are using this method. So how do you minimize taxes on house flipping? You can basically incorporate your business just like I mentioned in the previous slide. And once you incorporate, you will be paying 12.2% taxes rather than taxes on your personal income. As you make more money under your personal side, you pay more taxes. Rather than doing that, incorporate a flipping business and then close your property under the corporation and enjoy the lower taxes. Significant amount of savings are basically allowed to you. And now you must be wondering, in the flipping business, once I open a corporation, what other expenses are eligible or what other expenses can be claimed? So here's a quick list of expenses that you can technically claim if you are in the flipping business. Financing costs paid to the mortgage broker, cost of labor, material, architect, permits, realtor commission fees, legal fees paid to the lawyer at the time of closing. All of these are eligible expenses that you can claim against your profits that you have made when you're doing a flipping project. So I hope this helps, clarifying how you can save some money when you are in the flipping business and when you want to minimize your taxes. Here's my phone number and email. You can reach out to me anytime. Thank you once again for joining in.